I want to start with a number, 500,000.
That's a lot.
500,000 patient encounters every single day. That's how many blood draws, swabs, urine samples, and biopsies Quest Diagnostics processes in its labs every 24 hours. Quest is, in many ways, the hidden circulatory system of American healthcare. And today we're going deep after a Q1 2026 earnings report that beat on both lines and sent the stock up nearly 5%.
Revenue of $2,895 million versus the $2,829 million estimate, a $66 million beat. Adjusted EPS of $2.50 versus $2.34 expected, a 6.8% beat, and year-over-year revenue growth accelerated to 9.2%, the fastest pace in 3 years.
I'm Hudson Thomas, she's Lana Chen, and this is Charged Alpha, the S&P 500 stock encyclopedia. DGX is the ticker. Let's dig in. Section 2, Company Overview. Let me set the stage on Quest Diagnostics, because I think people underestimate just how vast this business is.
Quest is the largest independent clinical laboratory company in the United States. They process tests ordered by doctors, routine blood panels, cholesterol checks, thyroid function, but also advanced genomic sequencing, hereditary cancer screening, and complex molecular diagnostics. Basically, if a doctor needs to know what's going on inside a patient's body without cutting them open, Quest is often the company that tells them.
Founded in 1967, headquartered in Secaucus, New Jersey, about 55,000 employees, and they have this extraordinary national infrastructure, more than 2,200 patient service centers where patients go to get blood drawn, plus phlebotomists embedded directly in physician offices. The specimens come in, the labs process them, and results go back to physicians within hours to days.
Revenue comes almost entirely from diagnostic information services, roughly 97%. The remaining 3% is a healthcare IT business called Quantum that helps physician offices manage orders and results. Their test menu is over 3,000 offerings, everything from a basic metabolic panel to a hereditary cancer gene panel.
And the biggest news in the past year is the Life Labs acquisition. Quest bought Canada's largest lab company in late 2024. That added over $600 million in annual revenue and opened a whole new national market north of the border.
The moat here is a national-scale duopoly. Quest and LabCorp together control about 40% of the U.S. clinical lab market. You can't just start a lab network at national scale. It takes decades of physician relationships, collection infrastructure, and regulatory approvals. That's why this duopoly has been remarkably stable for 30 years. Section 3. CEO Background.
At the helm is James Davis, CEO since late 2021. Tell me about him.
James Davis came to Quest from Colfax Corporation, which is an industrial company, not a typical background for a healthcare services CEO. He joined Quest in 2018 in business development, became president in 2019, and took over as CEO in 2021 when the prior CEO retired. The operations-focused mindset he brought from industrial manufacturing has been evident in how Quest has approached cost management and acquisition integration.
Since taking the helm, he oversaw the Life Labs acquisition, the largest in Quest's history, and has pushed harder into advanced diagnostics and genetic testing. On Q1 2026, his tone was confident.
He highlighted strong underlying volume growth, said Life Labs integration is ahead of plan, and reiterated the full-year guidance. His focus is on hospital lab outmigration, the idea that cash-strapped health systems should outsource their expensive in-house labs to Quest. It's a long-cycle opportunity, but a meaningful one. Section 4. The numbers.
All right, Lana, the numbers. Walk me through it.
Q1 2026 revenue was $2,895 million. That's up 9.2% year-over-year from $2,652 million in Q1 2025. It's also a meaningful beat over the $2,829 million estimate. The labs consolidation contributed roughly $200 to $250 million of that growth. Organic growth in the mid-single digits.
Margins?
Gross margin is 33.2% on a trailing 12-month basis. Operating margin is 14.3%. Net margin 9.1%. These are respectable but not extraordinary. Diagnostic labs are capital-intensive, and routine testing is partly commoditized.
For context, that's very different from MSCI's 83% gross margin.
Very different. Quest is more of an infrastructure business. You're paying for the collection network, the lab equipment, the specimen handling, the logistics. The margins are earned by processing enormous volume efficiently. EBITDA margin is about 17.6% TTM.
Valuation?
P/E is 22.1 times trailing earnings. Forward PE is about 19 times on 2026 consensus. Price to sales is 2.0 times. EV/EBITDA about 14.8 times. Market cap is $22.76 billion at a stock price of $205.59. Those are reasonable multiples for a defensive healthcare compounder, not cheap, not expensive.
Cash flow?
TTM free cash flow is approximately $1.32 billion. Operating cash flow is approximately $1.86 billion. Capital expenditures consume the difference. Quest spends heavily on lab equipment, IT systems, and collection center build-out. The FCF yield is about 5.8%, which is attractive relative to the risk profile of this business.
What about the balance sheet?
It's leverage-heavy. Cash of $393 million, total debt of $6.98 billion, net debt of $6.59 billion. Net debt to EBITDA is roughly 3.3 times, elevated but manageable. Interest coverage is about 6 times. The larger issue is goodwill. $9.1 billion sitting on the balance sheet from years of acquisitions, including Life Labs. That's over 54% of total assets. If any major acquisition underperforms, impairment charges could be painful. But the flip side is that Quest has been acquiring and integrating labs for 30 years. They have a track record. Overall, Quest's financial health is solid. The free cash flow is real, the interest coverage is comfortable, and the business model is structurally defensive, but the leverage and acquisition-heavy balance sheet are worth watching. Section 5. What the Street Thinks.
What does Wall Street think about DGX?
The consensus is hold. 18 analysts cover the stock, 7 buy ratings, 9 hold, 2 sell. Average price target is $218, about 6% upside from $205. The target range runs from $190 at the low end to $250 at the high.
Notable calls?
Barclays has an overweight with a $240 target. Jefferies is buy at $235. Mizuho rates it outperform at $200. Evercore ISI is in line, essentially neutral at $210. UBS is neutral at $200, essentially at the current price.
And the Q1 report itself, how'd the street react?
Stock was up 4.7% on the day, which is a strong reaction for a healthcare services name. Revenue beat by 2.4% and EPS beat by 6.8%. Those aren't enormous misses or beats in absolute terms, but for a company that trades at 22 times earnings, beating on both with accelerating revenue growth is a meaningful signal. Management reiterated full-year guidance for $10.80 to $11.20 in adjusted EPS. Section 6. The bull and bear case.
Let's lay out both sides. I'll take the bull case.
Go ahead.
First, hospital lab outmigration is the secular tailwind. Health systems are under financial pressure, and their in-house labs are expensive. Quest estimates the annual addressable market for lab outmigration at $3 to $4 billion. They have barely scratched the surface, making this a genuine multi-year compounding opportunity that doesn't depend on macro tailwinds. Second, Life Labs integration is ahead of plan. Management says synergies are exceeding the original timeline, and the Canadian market is a new runway for growth. If Life Labs performs as expected, Quest has effectively added a durable new growth platform. Third, advanced diagnostics is the margin expander. Genomics, oncology biomarkers, hereditary disease panels, these grow at twice the rate of routine testing and carry significantly higher margins. Quest's Haystack Oncology and Blueprint Genetics acquisitions put it at the frontier of liquid biopsy and early cancer detection. Fourth, defensive positioning with a low beta. Beta of 0.65 means DGX moves less than two-thirds as much as the market. In a volatile macro environment, that's a genuinely attractive characteristic for a stock that can still grow revenue at 9%. And fifth, capital returns are consistent. Annual dividend increases for over a decade, a buyback program that has retired roughly 30% of shares outstanding over the past decade, and $1.3 billion in free cash flow to sustain both.
All right, now the bear case.
Let's hear it.
First, PAMA reimbursement cuts are a structural drag that never fully goes away. The Protecting Access to Medicare Act mandates that Medicare reimburse lab tests at rates derived from private market pricing surveys. Each reset clips 5 to 10% from routine test pricing, and Medicare is about 15% of Quest's revenue. It's a persistent headwind. Second, the balance sheet is acquisition heavy. $6.6 billion in net debt, $9.1 billion in goodwill. If Life Labs or any prior acquisition disappoints on revenue, the goodwill impairment charge could be very large relative to Quest's market cap. Third, margins are low by healthcare standards. A 33% gross margin and 14% operating margin reflect the partly commoditized nature of routine lab work. Meaningful improvement requires years of test mix shifting toward advanced diagnostics. That's a slow process at this scale. Fourth, competition from hospital-owned labs is resilient. Many major health systems have already invested heavily in in-house infrastructure. Academic medical centers in particular compete directly for the high-margin advanced tests. And fifth, government payer policy risk. 30% of revenue from Medicare and Medicaid. Any broad cost containment effort from CMS could hit Quest disproportionately as a high-volume reimbursement-dependent business. Section 7. Peer comparison.
How does DGX stack up against its peers?
The most direct comparison is LabCorp, ticker LH, which is Quest's duopoly partner and primary competitor. LabCorp trades at about 1.82 times sales and 18.5 times earnings, slightly cheaper than Quest's 2.02 times sales and 22 times earnings. LabCorp also has a larger CRO drug development services business, which adds revenue diversity but slightly different risk.
So Quest commands a small premium over LabCorp.
About 10 to 15% premium on PS. The market is pricing in Quest's advanced diagnostics mix and the Life Labs growth optionality. Whether that premium is justified depends on whether management delivers on the integration and outmigration thesis.
And on the diagnostic tech side,
Illumina, ticker ILMN, is at 5.15 times sales but has no meaningful earnings right now. Hologic at 3.8 times sales and 17.5 times earnings. That's a women's health diagnostics company with proprietary platforms that command a premium. Quest trades at a discount to both on PS, which reflects its more commoditized revenue base but also its consistency.
So the takeaway is DGX is the value-ish compounder in the diagnostic space.
Exactly. It's not the growth at all costs story, it's the steady, cash-generative, defensively positioned compounder that's starting to accelerate. Section 8, Options Activity.
Let's look at options market signals.
Post-earnings, options are calm. IV is at the 28th percentile. The pre-earnings spike has completely deflated. Implied volatility is 22.4%, modest for healthcare. Put-call ratio is 0.52, tilted bullish. The market is not rushing to buy protection on DGX at these levels.
Where's the open interest concentrated?
The $200 put strike and the $215 call strike carry the highest open interest. That tells you the market sees $200 as near-term support. There's likely meaningful institutional hedging at that level, and $215 as the first upside resistance heading into Q2. As always, options positions include hedges, not just directional bets, so the exact interpretation requires context. Section 9, Insider Activity.
Any insider activity worth noting?
Routine selling. 5 transactions in the past 6 months, all sells, 0 buys, approximately 18,000 net shares sold. CEO James Davis and other officers have made programmatic 10b5-1 plan sales consistent with compensation vesting schedules. Nothing unusual or concentrated. With the stock near its 52-week high, the absence of insider buying is unremarkable. Quest's primary capital return mechanism is the corporate buyback, not individual insider purchases. Section 10, Risks and Watch Points.
Key risks and watch points.
4 to monitor closely. First, PAMA reimbursement rate reset timelines from CMS. Any acceleration of price cuts would hit margins directly. Second, Life Labs integration milestones. If management stops talking about synergies being ahead of plan, pay attention. Third, competition from hospital lab consolidation and regional chains. Fourth, government payer policy risk from Medicare and Medicaid. Revenue per requisition is the single most important operating metric. It captures both pricing and test mix trends. Total test volume growth shows whether physician ordering is accelerating. And watch the Life Labs revenue line specifically, since management will eventually need to disclose whether that acquisition is delivering as promised.
Forward catalysts.
Q2 2026 earnings in July. First real test of whether 9% growth is a trend or a one-quarter story. Any M&A announcements. Quest is an active acquirer of regional labs, and CMS decisions on PAMA implementation, which can shift the reimbursement landscape. Section 11, the bottom line.
Let's bring it together. The verdict on DGX.
Quest Diagnostics is a national diagnostic infrastructure company with a genuine moat, a defensive revenue model, and a credible growth thesis built on hospital outmigration and advanced diagnostics. The Q1 2026 double beat confirms the business is performing well. The risks are real: leverage, PAMA pressure, acquisition integration, but they're not existential.
And the key metric every DGX watcher should track: revenue per requisition and total test volumes. Published quarterly with earnings. Quest processes 500,000 encounters a day. A sustained acceleration in both metrics, even at the margin, confirms the outmigration thesis and drives operating leverage. Watch for LifeLab's contribution disclosure and the organic versus acquired revenue split on every earnings call. Section 12, closing quote plus CTA. We close every episode with a quote that captures the company. For Quest Diagnostics, the data company of healthcare, this one is perfect. From management pioneer W. Edwards Deming, "In God we trust, all others must bring data."
And that is Quest Diagnostics' entire value proposition. They are the ones who bring the data.
That's going to do it for this episode of Charged Alpha on Quest Diagnostics Incorporated. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas. Section 13, outro, required disclosure.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.